All right, let's talk PagerDuty. We're diving into their Q3 earnings report, and wow, this one sent some serious shockwaves through the market. So let's just get straight to it.
So get this. PagerDuty comes out. They absolutely crushed their earnings estimates. We're talking a 32% beat, and they even raised their profit forecast for the whole year. Sounds great, right? Well, the very next day, the market turns around and tanks the stock by over 23%, a total freefall. The big question, the one we're going to unpack here, is what on earth just happened?
Okay, so this quarter was a real story of two different companies inside one report. It was a classic case of mixed signals, almost a paradox, really. On one side, you had just incredible strength when it came to making money, but that was clashing head-on with some really concerning weakness in their growth. And it was that exact conflict that just spooked the market and led to that brutal sell-off.
Just look at this. It's pretty stark. On the one hand, you've got this incredible bottom-line strength. Their earnings per share, 33 cents, which blew past what everyone was expecting. And their operating margins? They expanded by a massive 750 basis points. I mean, that is just stellar execution. But then you look at the other side, the top-line weakness. Now, the small revenue miss, okay, that's one thing. But the real killer, the number everyone was watching, is that dollar-based net retention rate, or DBNRR. Now, what this number tells you is if your current customers are spending more money with you over time. And it fell to exactly 100%. It was 107% just a year ago. A flat 100% means your existing customers have, on average, completely stopped increasing their spending. For a software-as-a-service company, that is a huge, flashing red flag.
So with this, let's call it a split personality in their report, you might think management would be scrambling. But they didn't panic. Nope. Instead, they came out with a very clear, very deliberate story. They said, look, we are actively pivoting this company. They're moving away from that old Silicon Valley mindset of growth at all costs and shifting towards something they're calling a durable, profitable growth model.
And the CEO, Jennifer Tejada, she was super clear about this on the earnings call. She framed the whole quarter as, and I'm quoting here, evidence of disciplined execution and a durable, profitable growth model. So the big takeaway here is that this focus on profit wasn't some happy accident. It was a choice. And you know, this isn't just a PagerDuty thing. We're seeing this all across the software world. That whole era of cheap money fueling growth at all costs, it's over. The market now wants to see that you can actually grow and make money at the same time.
So, to tackle these challenges head-on, management laid out their game plan, and it's basically got three key parts. First, they're changing up how they charge customers. Instead of just a simple per-person license, they're moving to a model based on usage. This is a direct shot at what they call seat compression. You know, when big companies downsize and cut the number of software seats they're paying for. Second, they're going all in on AI, launching a new AI agent suite. And third, they've got a new chief revenue officer who's completely overhauling their sales strategy to get cozier with their big enterprise customers.
Okay, so management has a plan. It's solid, it's logical, it makes sense. But the market just didn't care. It's like investors put on blinders. They looked right past all those great profit numbers for the quarter, and they zoomed in on one thing, and one thing only, the guidance for the future. And it was not good. And this right here, this is the heart of the problem for investors. You can see it plain as day. The company actually raised its profit forecast for the year, but they cut their revenue guidance. And that right there confirmed the market's absolute worst fear, that growth is grinding to a halt. The real knockout punch, though, was the guidance for the next quarter, Q4. They basically guided to between 0 and 2% growth. The market heard 0 growth, and that was it. The sell button got smashed instantly.
And I mean, they didn't just hit the sell button, they slammed it. To put this in perspective, on a normal day, about 2 million shares of PagerDuty get traded. The day after this report, almost 19 million shares. That is a 9 times increase. An insane amount of volume. And listen, this wasn't just a bunch of nervous retail traders. That kind of volume, that's what we call institutional-grade de-risking. That means the big money, the huge funds were heading for the exits. It was a fire sale.
So after all that carnage, the big question is, where does the stock go from here? Is this the bottom? That's what we're going to tackle in our final segment, the next call. We're going to pull all this together and give you our official rating and even a potential trade idea.
And this really brings us to the core debate, doesn't it? For anyone looking at PagerDuty right now, this is the question you have to ask yourself. With the stock just hammered down like this, is it a golden opportunity, a deep value play, given how profitable they are? Or Is this a classic value trap where that slowing growth is a huge warning sign that there are much bigger problems under the hood? So our official rating for PagerDuty is Market Perform. And look, we feel this rating really nails the situation right now. It's a standoff. On one side, you have this company that is an absolute cash machine, super profitable, really well run operationally. But on the other side, there's just this huge cloud of uncertainty around whether their new strategy can actually get growth going again. PagerDuty is officially in a show-me story mode. And until they can prove, with numbers, that they can grow again, we think the stock is probably just going to tread water with the rest of the market at best.
All right, now let's talk about a potential trade idea here. Our thinking is this. The market has punished the stock for stalling growth, for sure, but it hasn't priced it for a complete collapse. And with their profitability and that AI stuff they're working on, there's still some long-term potential. So what you could consider is selling cash-secured puts. Now what that means is you're essentially getting paid today to agree to buy the stock at an even lower price in the future if it drops that far. So for example, you could sell the $10 puts that expire in March 2026. Here's how that plays out. You get cash, that premium, in your account right now. If the stock stays above $10, you just keep that cash. Win. If it drops below 10, you have to buy the shares, but you're getting them at a huge discount to even today's beaten down price. The big risk, obviously, is that the growth story completely falls apart and the stock blows right through your $10 entry point.
And that's our take on what was, without a doubt, a very challenging quarter for PagerDuty. Of course, please remember, this is for informational purposes only. This is not financial advice.